Happy New Year. Thank you so much for joining us on Global-Signs. I'm Bruce Hahn. We have a very special guest for our first show of the new year. We'll be speaking with Jessica 커트레라, president of Leo Wealth based in Hong Kong. Leo Wealth is an outstanding independent global wealth advisor who provides advice and guidance on wealth management, tax and estate, investments, and insurance. Jessica, welcome to the show.
Thank you.
Can you tell our viewers about Leo Wealth, please?
Sure. Leo Wealth is a global multifamily office that focuses on meeting the needs of global citizens. That really means that we work with individuals and families who touch more than one place, either through tax, estate, assets, investments. Our job is to provide them with comprehensive investment advice, estate planning and insurance solutions, tax planning and tax solutions, and global wealth management.
Quantitative easing policies are ending around the world, with the FOMC at its last meeting suggesting 3 possible rate hikes in 2022. Under these circumstances, what changes do you foresee in terms of attractiveness in the developed, emerging, and Korean stock markets, and how should investors respond to interest rate hikes?
Fortunately, the Fed has been very transparent and forthcoming with their policy expectations, and that makes it easier to plan. Now, we do expect the Fed to remain transparent. We expect them to be quite cautious. So while it is possible that we have 3 rate hikes this year, we expect the Fed to be quite adaptive, looking at how markets are recovering, what that means in terms of overall quantitative easing, what's happening with global economies. So broadly, we're still quite positive on equities. Equities, more often than not, tend to be higher for 12 months post the first rate hike. We do expect this to overall be a slow inflationary cycle without rapid rate hikes unless there is really the economic data to support it. In terms of really what that means in developed markets, our biggest concern is fixed income. So while we're positive on equities across developed, emerging, and Korean markets, we're much more cautious on fixed income. Given that rates are so low and the pending rate hikes, there aren't many places for investors to go. We see some allocation to developed market corporate bonds, some into high yield and potentially into TIPS, the inflation-protected securities. But traditional fixed income is going to provide a limited return and yield and potentially significant downside.
COVID-19 situation is not improving. How will this affect both developed and emerging stock markets? What should investors do?
So the real damage that COVID does to the economy is not the illness, but rather the economic lockdown. And while the spread of COVID is not improving, the new variant Omikron looks actually that it's more transmissible than Delta, but overall we're seeing milder symptoms and we're seeing significant resistance from almost every economy. Hong Kong and China may be the exception, but there is not much appetite for economic lockdown. And that is really where the COVID damage does to stock markets. Now, certainly we're at the later stages of a recovery. We expect to see more volatility. We expect that global growth will continue to move ahead, but probably at a slower rate with more volatility. And as developed markets more fully recover, we expect emerging markets then to do the same.
The rise of oil seems to be one of the causes for an uptick in inflation. What is your view on oil prices?
So we have seen oil and other energy prices that have certainly contributed to the rise in inflation. We do see part of this as a supply issue. So ultimately, and the supply issue component, we expect to work itself out in the near term. We'll get to a place of easing on some of the constraints. Certainly, we will normalize in terms of things like shipping and freight costs. We've had years of underinvestment in CapEx in the crude oil space. We do think that combined, all of those factors are going to drive oil prices moderately higher, potentially another 10 to 15% than where they've started at the beginning of the year. We expect estimates somewhere in the range of potentially $80 to $90 a barrel for crude for 2022.
Chinese internet stocks started 2021 last year on a positive foot, but have since become among the world's worst investments, having lost a third of their value from where they were at the start of 2021. What do you think about them and about investing in China in general?
China was certainly near the bottom of the list for 2021 in terms of performance. We saw a little bit of disparity based on whether Chinese companies were listed locally, which fared a bit better, versus US listed, which fared the worst. Now, that's a combination of government action, changes in policy, and we're starting to see a slowdown in GDP growth in China. All of that has really presented challenges and made 2021 a really disappointing year for anyone investing in Chinese equities. Our view is that investing in China is still interesting, but it requires patience, and it's going to be really important to look at the fundamentals of the companies you're investing in, as well as have a political overlay in how those companies are positioned. In general, we have a strong preference for companies that are listed domestically. As we've seen, US-listed companies are potentially far more vulnerable, and it's going to be important to watch the ways that China is ultimately implementing soft power and moving forward with regulation.
How will the defaults of both Evergrande and Kaiser affect both the Chinese and other stock markets globally?
One of the big challenges with both of those events is really about investor confidence. So for years, there have been discussions about the moral hazard in China of people making investments in companies, regardless of their financial solvency, with the view that the government would bail them out. And many of those companies, those bonds, have made their way into wealth management products that were distributed domestically at a retail level, in many cases to investors who probably didn't understand what they were buying. So we really, for investors, the takeaway there is you can't rely on the government to backstop you, and you need to be cautious and make good individual decisions about the equities you're purchasing.
Jessica, what is your view on digital currency?
It's not yet its own asset class, and the term currency is almost a bit of a misnomer. These cryptos are really not being used to buy and sell things. They're not used for transactions. They're in many ways being treated and used as a digital gold. So there's a store of value component of them. They are being seen as potentially a hedge to inflation. And more investors, both individually and institutionally, are incorporating them into their portfolios. So for us, there are a couple of components we think are really important when you're looking at digital currency, and the first is risk management. Our advice to investors at this point is to focus on the more established currencies that are institutionally backed. For us, that's Bitcoin and Ethereum. We're comfortable holding those in small amounts as part of an inflation hedge strategy.
Now, Jessica, finally, can you recommend any interesting sectors to our viewers today?
So going into the late stages of a global recovery, we think that there's going to be very interesting opportunities predominantly in value stocks. We're still positive on energy and financials. So banks and financial services companies lagged in the recovery, and consuming in general. So beyond banks and energy, we also think that there's a lot of opportunity in the consumer space. It's going to be really interesting to see how consumers spend again as the world is opening up.
Jessica Cuchera, dynamic CEO of Leo Wealth based in Hong Kong, thank you so much for taking your time to talk about the stock markets, the bond markets, and digital currency, and also the various sectors. I wish you and your firm continuing success in the new year. Thank you again.
Thank you.
That does it for our first show for the new year. Thank you so much for joining us. Until we meet again next week, please be safe, healthy, and vigilant.